Welcome back. So far, so good. 400 points up on the mid-cap index, and you've got a 200-point rally on the Nifty that's intact. Now, the one pocket that's not participating today is actually IT, led by TCS on the way down. Let's just pull up the stock today. It's down about 3.5%. Now, the question is, when you've had such a great journey, I mean, look at the last 1 year for TCS. The stock's come off about 15% from its 52-week high. The question is, was there enough ammunition in what the management has said, what they've delivered in the second quarter, to keep this momentum going on the stock? Of course, Rima, that's exactly, I think, what you were trying to find out. You had a whole conversation with them. Yeah. What are the takeaways from Q2?
Well, at least today, the stock is under pressure, one, because of the rupee appreciation. Yeah. And secondly, there were no earnings surprise. A lot was baked into the price. In fact, there was a bit of a miss when you come to the growth number. The company reported a 3.7% constant currency growth on a quarter-on-quarter basis, lower than expectations of 4.2%. Yes, they did hit the double-digit mark of 11.5% when you look at it on a year-on-year basis. And they managed to do that after many quarters. And the company said that they have the numbers and the momentum to ensure that this double digit continues for the rest of the year, which means FY19 is going to see a double digit growth rate, something they didn't see in the last 2 years. Margins too got the benefit of the 4.5% rupee depreciation, so margins improved by 150 basis points. They came in at 26.5%, which means back within the company's guided band of 26 to 28%. And remember, for the last 6 quarters in a row, the company was trading below the lower end of that guided band. So getting back into it is also a positive. Digital is the big growth driver, now 28% of the overall revenues. And look at the way digital growth has been accelerating. A year ago, the growth was 30%, and now it's come to about 60%. The management said that they're still monitoring retail, auto, communications, and the technology sectors. And as Surabhi pointed out, yes, the stock in the last few weeks has seen a correction of nearly 15% from its lifetime highs of 22.75. It's still up 42% on a year-to-date basis, which would put the stock trading at 22.5 times F519 PE and close to about 20 times forward multiple. Nomura says that they expect a marginal downside to the consensus growth numbers, and that's largely on account of that Q2 miss on the top line. Credit Suisse says the Q2 numbers are solid, but not enough for an upward earnings revision. And CLSA says that they've kept the target price at 2,600. They continue to believe that TCS will, post industry-leading growth momentum. So what the market sense is that a double-digit growth in FY19 was anyway in the price, and that has come through, and that has been reinforced by the management. But that was already known and in the price. What the street wanted to get a sense was more about the medium-term outlook and whether the company can accelerate its growth, not just sustain a double-digit growth, but accelerate it from here on. Whether a 10% growth in FY19 can become an 11% growth in FY20. But as of now, I guess it's too early. We tried to quiz the management for more on that, but we didn't get any color on that. I had a chat with the top management of TCS, with the CFO, the HR head, as well as the BFSI head. Let's find out what they have to hear. I started off by asking more about the margins, because the operational leverage that they got was only about 30 basis points, and this is despite a double-digit growth in the revenue. Could they have eked out a little more in terms of operational efficiencies? Listen in to what they had to say.
If you look at it, last quarter we had about 70 basis points. So I think it's a continuation of a journey, right? So you will have in one quarter higher and lower, but the fact is that it's a continuing program. So 30 is not small for our size of operations.
Okay. In the past, TCS has also enjoyed margins to the tune of 30%. Now we've got a phenomenal rupee depreciation that should provide a big tailwind. So if not going back to 30%, at least should we go towards the top end of your margin band?
See, we will continue to stay focused. See, we've been this of 26 to 28 is what we said. This is our preferred range. And for the last some time, we have not been in that. So now that we have come into it, so let's wait for a while. But the focus is clearly on making sure that we maximize whatever are the opportunities and to stay focused on that.
Kriti, NGS said that he wouldn't go as far out to say that we could see a double-digit growth in BFSI into FY19. Give us some insight into FY20.
See, we expect the overall demand environment is good, and our customers are utilizing our Business 4.0 transformation framework a lot. And as I'm sure NGS would have explained, our growth is also very broad-based, like across all geographies, across all industry sub-verticals, we are seeing growth. So instead of commenting whether we would be double-digit or not, I would say it's a very positive momentum we are on. The trajectory is good.
So it should continue to accelerate. You don't expect momentum to sustain, you expect it to accelerate.
See, the current growth rate at least you would be happy to maintain. That's the way I would put it. Accelerate, I don't know which way you understand, but we are quite happy with the momentum we are on.
Okay. Ajoy, you've added 10,200 employees this time. This is the highest that we've seen in the last 12 quarters.
Right.
Is that on account of a stronger demand? And can you continue to add close to 10,000 employees every quarter and maintain attrition at 10.9%?
See, our goal is that, yes, I would love to have attrition lower so that I can retain people, so that once people come in, we are giving enough opportunity for them to grow. And that has been our stated kind of philosophy, that we try to hire people so that they make a long-term career in TCS. And we do not believe in hiring, firing kind of a model. Now, the question of the 10,000 addition, yes, it's in the last 12 quarters, this is the highest. And that is primarily to fuel because of the growth that we are seeing, and the current growth as well as what we see in the future. So it is to take care of that growth. At the same time, we have also talked about machine first delivery, right? So it's the interplay of the machine as well as the humans. So both put together, that's the interplay that happens. And as a result, we are going to hire. But whether it will be 10,000 every quarter or not, that will be difficult. But at the same time, our hiring will be much more robust than last year. This first half, we have done 16,000 net compared to 7,700 in the whole year. So hiring is going to be pretty strong.
Okay. Ranki, back to the margins and the rupee impact. All things equal, what was the benefit on account of the rupee, a 4.5% rupee depreciation to your margins? You have reflected 120 basis points. What we want to understand is, have you reflected the entire benefit? What would it have been?
Typically for every 100 basis points of revenue, considering our mix of currencies and considering the business where we are, we typically get about between 25 to 30 basis points, and that's what you're seeing.
So the entire benefit is reflected.
So there is no question of, that's a function of how the projects have been delivered, etc. So there is nothing, not much of flexibility around that. So 390 basis points we got on the revenue because of the currency, and 120 basis points we got into the margins, which is in line with...
How is competition responding to the rupee benefit? Are you seeing increased competition when deals are being up for bidding?
See, I think a sharp depreciation has happened only in the last 3-4 months. I think the entire model works on, I think Rajesh had explained it quite succinctly yesterday, as also in earlier interactions, that the entire model is based on the differential inflation between the country where we perform the services and where our customers are situated. So currency plays a factor into that, and on a long-term basis, currency is something which we manage. From a competitive perspective, it's too early to say. There may be some opportunistic players who may use currency as a factor, but the business is, our entire services model is not price elastic.
Okay.
So it's not that you can lead on price, it's really on the basis of your solutions, on the basis of your delivery capability, your the value that you bring to the customer, and that definitely at scale we have those compelling propositions where price is one factor, but it's not all always.